Well, Fed officials today will meet executives from the nation's 20 top largest banks just days before the U.S. hits the debt ceiling deadline. We're less than 4 days away. Banks want to know what will happen if Congress fails to raise the borrowing limit. Well, for more, we are joined by Roger Altman. He's the chairman and founder of Evercore Partners, also the former Deputy Treasury Secretary under President Bill Clinton. Roger, always great to see you.
Hi, Betty.
What do you think about what is going on after the setback yesterday with Boehner's proposal? I mean, where do you think we're going to end up?
Well, first of all, I don't think we're going to default. It's important, though, to define what default means. To me, default means failing to make an interest payment or failing to make a principal payment. And I don't believe the United States will do that. Will we potentially go past August 2nd? I think that's possible in two ways. One, it may or may not be the final day because that depends on precise Treasury cash balances, which reflects in turn revenue flows, and those are only known to the Treasury. Number two, if forced to, of course, we can prioritize our payments. In other words, pay interest on time, service principal payments on time, and like any other pressured debtor, delay certain payables a day or two, or 3 or 4 days if necessary. So I don't think we're going to default, but that's how I define default.
Well, and I mean, and that's in many ways I would say that would be a technical default, right? I mean, basically that you're not making the payments on your obligations. When you said
no, I don't think so. I think as long as you're timely on interest payments and on principal payments,
you're not in default.
You're not in default, whether it's under any definition.
Okay, so that's right. That's what I'm trying to say then. So Roger, just getting to the prioritizing. If you were still the Treasury, what exactly would you prioritize then?
I might say that I really empathize with Secretary Geithner, so I'm glad I'm not there at the moment under that pressure.
He's called it unfair to be put in that position.
Well, I think you can only make that decision, Betty, in terms of prioritization on the very day and based on exactly what your cash is. The point is you must make your interest and principal payments. And as I say, if you have to delay payments to contractors or other types of payments for a day, it's not good, but the world won't end. You're not in default. That's happened in some respects before in the case of government shutdowns. So it's not a horrendous thing. So I don't think we're going to default based on the discussion or the definition I just gave you. It's possible, though, we would go into some form of overtime.
But judging from, how protracted this has been so far, coming up to August 2nd, how much down to the wire, it doesn't sound as if we passed August 2nd, it will only be one more day. I mean, it sounds like it could take several more weeks, perhaps.
Well, we don't know that. I would doubt that this would go weeks beyond the 2nd of August. I would strongly doubt that. You can see in financial market trading levels right now that markets are not expecting that. Markets are expecting that in one form or another, first of all, we won't default, and second of all, this will be resolved within this general August 2nd timeframe. And I think they're right.
Roger, what do you think should happen after all of this is resolved with the debt package? What is the opportunity there afterwards?
Well, if we step way back, why are we in this crisis in the first place? We're in it for two reasons. The first, we have an anachronistic process on the debt limit, where the debt limit is voted on separately from the budget, even though the debt limit is just a product of the budget. If we modernized that system, we would fold the debt limit vote into the budget vote, and you would only vote once. When you vote on the budget, the debt increases are automatic, and therefore there's only one vote. That's what we should do. Do I think that's going to come around anytime soon? No, I don't. Second of all, this is all about, of course, deficit reduction. Now, in the big picture, it is time to undertake deficit reduction. That's why the president put the Bowles-Simpson Commission in place, and therefore addressing deficit reduction today is the right thing, even though I happen to think that the effective date of it should be delayed, say, until 2013 to give the economy some more opportunity to regain its footing. But if we get a reasonable deficit reduction package out of this, reasonably large, reasonably balanced, and I'm skeptical on the balance right now, that will turn out in the long run to be a good thing, because we all know the deficit and debt overhang facing this country, and we should be addressing it. So the debt limit it may turn out that we're sitting here 6 months from now and we look back on this and say this anachronistic debt limit process turned out to be cathartic because it produced a deficit reduction package that wouldn't otherwise have happened.
Right. People say that it finally focused us on the long-term debt problems. Roger, do you think we're going to get a downgrade no matter what, though, in our U.S. sovereign debt rating?
I don't think that's clear. I think the rating agencies have to be extremely careful, Betty, on any decision like that. Because we have today a political crisis in Washington. We don't have a financial crisis. This is not Greece. This is not Italy. This is a political crisis. And therefore, the rating agencies, who I think have a tremendous amount of responsibility at this moment, should be quite careful in judging whether or not the underlying credit of the United States has actually weakened. And so I think they're going to think twice or three times before making any decision like that. And it's not clear to me that we actually will suffer a downgrade, although if this does go either into deep overtime or there really isn't any deficit reduction somehow, then that's quite possible.
Let me ask Roger this, because Roger, you had your quarterly numbers out yesterday, and you were actually quite forceful in saying that you don't see a soft patch in this economy. What do these numbers tell you, though?
Well, first, Betty, what I said yesterday was I don't see a soft patch in merger and acquisition volume.
Okay, let me read the quote. It says, "I believe that the economic recovery in the United States will not stall out, and I don't see a disappearance of recovery." That was in the context, though, of the soft patch. You're talking about it's a soft patch in M&A activity.
Well, the reference, I said I don't see a soft patch in M&A activity, and then, of course, you have the quote right there.
Right.
I stick by that. I don't think the recovery is going to turn to zero. I don't think we're going to slip back into recession. But these numbers we just learned are disappointing in the extreme, and they're disturbing. And by the way, they should serve as a clarion call to those in Washington to get this solved, because while those are numbers that reflect the past 6 months, and we're into July now and so forth, nevertheless, this stalemate in Washington is, of course, producing hesitation on hiring, hesitation on investing, hesitation on spending. And so it's not, we don't need this stalemate in light of how weak we already are. But there's no getting around the fact that these are disappointing numbers, both the second quarter at 1.3 and I think the quite shocking first quarter revision.
They are.
Hey, Betty.
And they're very serious.
Betty, let me jump in here on that point about Washington. There's a real warning in these numbers, and that is government spending dropped 1.1% on the month, and this is even before any kind of budget deal would cut more government spending. That would be the last thing we need at this point. You've got no consumer spending right now, very weak business spending, inventories didn't change at all, so there's almost nothing to build on in this report. And the worrisome number here is that inflation is higher. The personal consumption expenditure index up 2.1%. That's over the Fed's target. So you've got high inflation, no growth, and now they're talking about cutting even more out of the economy.
Roger, that's a good point. I mean, we are seeing this decline in government spending. If we're going to pass through some sort of package, we're going to see that decline even further. So I understand your point about how we need to get through this deficit debate, but at the same time, that will mean that it's tighter, basically austerity here in the economy, and that's going to mean a slower economy.
Well, Betty, I said in the earlier segment that the right thing to do is to delay the effective date of any deficit reduction package that comes out here till, I said, 2013. Some people think it should be 2014. But in any event, the impact of deficit reduction, which is obviously contractionary from a fiscal point of view and economic point of view, should be delayed. There's been a lot of discussion about that in Congress. That's not a new idea down there. I believe a number of the proposals, for example, the Reid bill, does incorporate that delay, and that's something that this new data suggests is very important to put off the contractionary impact of deficit reduction. I don't think it means we should drop the discussion in Washington. I think the right thing to do, and it's always been the right thing to do, and the president's talked about this, is to extend the payroll tax cut, for example, and maybe there's one or two other items of additional last dose of stimulus, in the context of a long-term deficit reduction program that would begin, say, in 2013.
Data, which just basically no way around it. It is not good for the economy here. It's not good, a good indication of what's to come, perhaps. What do you think this indicates with the jobs market?
Well, it's negative. Most economists think we need 2% growth, approximately, to offset population growth and to create net jobs. And obviously, for the first 6 months, on average, just taking these new numbers, we grew at about 1% over the 6-month period. So the short-term implications for labor market conditions aren't good. We all know that the monthly job numbers bounce around a lot, and there are differences between the payroll survey and the household survey and so forth. But this is not enough growth to reduce unemployment, to reduce underemployment, to improve the labor participation rate. It just isn't. So the short-term outlook for the jobs market, based on this data, is not positive.
No, and it basically indicates that we're not going to see this jobless rate go down.
Not in any serious way. Not based on. We just don't have enough growth to reduce it. I mean, none of us knows whether the next month will be 9.0 or 9.2, 8.9, 9.3. But in general, the labor market conditions are not going to improve based on this poor growth.
Roger, do you think that, you talk to a lot of CEOs, obviously. I mean, do you think that what is going on in Washington is part and parcel of why they're not hiring?
No. Maybe in a small way, Betty, but there's this giant debate about the amount of liquidity on corporate balance sheets and the absence of hiring. And that debate has been occurring for the past year or so, and this debt limit stalemate has been on the table for a few weeks, or even less. So I think the broad issue in terms of hiring has to do with uncertainty about final demand, and this economic data, unfortunately, validates that uncertainty, right? So what CEOs say most of the time, maybe not in the last week or two, but most of the time, is we're not sure about the strength of this recovery,
right,
and therefore we're hesitant about hiring and investing. And I think so. I think that uncertainty and this disparity between corporate liquidity and hiring transcends the debt limit debate primarily. It's about the strength of the recovery, and we just saw reasons why there is so much uncertainty.
For you, though, you're on the opposite end. I mean, I think in your conference call yesterday, you used the words aggressive, that you'll be aggressive in hiring from here on out, right?
Well, our business is good. We had a record quarter yesterday, all-time record quarterly revenue, all-time record quarterly earnings, and so forth. And our business, like there's no way around it, is strong, is very steady. So we have been adding people. We added a lot of people for us between the end of the first quarter and the end of the second quarter. We're going to continue to add people. And that's now we're not the world's biggest firm. We have 800 employees. It's a lot bigger than when we started, but it's not the biggest employee base in the world.
Right.
But no, we are consistently hiring.
Roger, thanks so much for staying
Likewise,
with us
Betty.
through this hour. Roger Altman, the chairman and founder of Evercore Partners.